Is that a guy post on my YouTube channel about a stock that had 11% dividend or something like that is a pretty significant dividend. I said, that's just odd. I want to dive into that stock and look at it a little bit because 11% dividend is pretty significant for sure. And if you're getting 11%, there's a reason you're getting that. I don't know what it is. I don't know who the guy who posted seems like a nice guy. But let's dive into this as you're looking for dividends to see what you're looking for before you just buy it. I'm not saying this guy's doing that. I don't know. But let's take a look because I thought that was interesting. I thought this might be of help for you if you're looking at dividend stocks. I know a lot of people say, oh, it's paying 11% dividend, insinuating they get 11% with no risk, or insinuating they get 11%. The dividend can't change, or insinuating that I don't know what the insinuation is actually, but there's a lot of risk that goes with dividends. Let's put it that way. Just because it pays the dividends doesn't mean it's not risky. It's just watch another guy's YouTube channel talk about dividend stocks, so they're slow and steady and utilities, blah, blah, blah. And did you not just read about PG&E? Did you not see GE? Just because it pays a dividend does not mean it's without risk. Let's just look at that. So subscribe down below, and let's dive right into this. So I'm just looking at Yahoo Finance. I'm looking at NRZ, National Residential Investment Corporation. I think this is a REIT, the Real Estate Investment Trust. Let's see, it's traded on New York Stock Exchange. We know that because it has an NRZ, 3 letters in the ticker. So that means it's traded on New York Stock Exchange. It means it's a blue chip. Right, and let's just take a look. So right now it's got forward dividend and yield at 2%. Or $2 a share. So we take your I got my trusty calculator. Yes, I do. Look at that. So we take that $2 a share and we divide that into the price, which is $16.13. So 2 divided by 16.13, and they're saying a 12.3% is kind of like what they're expecting for a forward 12-month dividend yield. So it's just a dividend amount divided into the price per share. That's your dividend yield. And obviously, that's going to change because the price probably won't stay at $16.13 for the rest of 52 months. All right, but anyway, so the PE ratio is 4.24. Why is the PE ratio so low? That's odd to me. I mean, that's an incredibly low PE ratio. That's like 1978 blue chip PE low ratio. So in of itself, like, wow, I got a fat dividend and a low PE. I like that. Beta is 0.88, so it's less volatile than the S&P 500. I like that. Market cap is $5.89 billion, so certainly not a penny stock. All right, it's not trading on the pink sheet, so I like that. Has some market, not say stability, but has some market size, which is good. Trades at $5.2 million as the shares it trades every day, so heavy volume too. So that's all good. I like that, what I've seen so far. So now I want to go to financials. Let's take a look here because it's paying that much of a dividend. What was that about? So the first thing I want to do is I'm going to go to historical data. Historical data. I want to see what the dividend has been over time. All right, so we're going to go to historical data. And we're going to go to show not historical prices, but dividends only. And we're going to hit apply. Let's take a look at this guy here. And so it's paid 50 cents a share 4 times from March 2018 to December. Okay, that's just last year. So let's go to Max 5/2/2013. I guess that's when this company was IPO'd, initial public offering, I presume. Hit apply. And okay, so they've only been paying a dividend for the last year. Oh, here we go. Okay, sweet. All right, this is good. All right, no, yeah, okay, so good. Look at that. The rising 1.7, 17 cents and a half, 38 cents, 45 cents in 2015, 46, 50. So they've been paying 50 cents dividends. They've been paying good dividends, increased dividends. 2013 is again 17 cents a quarter. All right, so they've been paying increasing dividends each year. Each year they've increased their dividends. So far so good. That's 3 for 3. Fat dividend, low PE ratio, and increasing dividends. I like that. And on top of that, they're decent sized market capitalization and lots of volume. I mean, that means there's a lot of activity in there. That's good. Still seems odd to me. So let's look at the financials. Let's see what we got here. We're going to hit financials. Okay. So total revenue. Okay, look at that. Revenue went from 564 in 2014, went down a little bit. So revenue's basically tripled in the last 4 years. That's pretty good. Where cost of revenue, has gone from 3.9, thousands That'd be millions, 3.9 million to 218 million. Oosh. So the revenue has increased by triple, but their cost of revenue has gone from 3.91 million to 218 million. That's interesting. Operating expenses. Let's see here. Operating income or loss. So their operating income has gone from 460 to 1.1. Is that billion? No, I guess that doesn't say it's in millions. So millions. So 460,000. 2014 was the first operating profits. That's good. They have, and then went down to 287, went to 621, then went up to 1.18 million in 2017. So that's operating income. That's not profit or loss. So let's see. Income from continuing operations. Net income from continuing ops went from 442, so again, about 2.5 times. So that's good. I'd like to see that. Net income went from 352 to 957. So that's good. So net income is tripled. So net income has tripled even while their cost of revenue has gone. I'm not following that. I don't get that. But their net income has tripled while the revenues have tripled. So that's good. You don't want to see revenue increasing and net income staying flat. You want to see net income going up as well. So that's interesting. So let's keep looking. All right. So that's financials. That's the income statement. Let's look at the balance sheet. The first thing I want to find out is how much cash they have relative to the debt. Now, if it's a real estate investment, they probably got a heavy debt, but we want to see, are they generating enough cash to pay the dividend? So they got $295 million in cash. Okay. Net receivables, $3.35 billion net receivables. Yeah, that in of itself could be good or could be bad. How many of they're going to have to write off? I don't know. I don't know the answer to that. But they only have $295 million in cash, which is a little bit higher than what they used to have when they started in 2014, but not significantly higher. And the receivables have gone from 71 million to 3.36 million. I don't know if that means they're not satisfying the receivables. I don't know. That would be a concern to me if they got all these outstanding accounts receivable out there not turning into cash, because receivables don't mean anything if you can't get on cash. That's for sure. Current assets are 6.26, long-term millions, long-term investments of, okay, so good stuff there. And tangible assets, I don't know what that is. And so their total assets have gone from 8 million to 22 million. That's fine, but it could be just driven from liabilities. Let's see. Their accounts payables have gone up from 30,000 to 1.25 million. It's in thousands. Okay, never mind. So that's 1 billion. So accounts payable is 1.2 billion. And the receivables are 3.6 billion, which is why their current assets are pretty high relative. That's good. You want current ratio to be high. But their current liabilities are 8 billion and their long-term debt's 9 billion. So the current liabilities have gone up 4 times basically. And their long-term investments, their current assets are, so net receivables 3 billion, current assets 2 billion, other current assets, total current assets 6.2 billion, total current liabilities 8.27 billion. So the current ratio is negative. Less than 1. That means they have more liabilities than they have current assets. I don't like that so much. Long-term debt is 9 billion, and long-term assets investments are 13 billion. So we like to see that. My inclination is probably properties actually. So they're carrying on more investments than they are on debt. But those are buildings, I imagine. And then net long-term liabilities 17 billion. And long-term assets, 22 billion. So they have at least they have a net worth, positive net worth. Let's see what we got here, though. Okay, so yeah, net tangible assets. Okay, good. That's their net worth right there. That's not so bad. So now let's look at cash flow. I just want to look at net incomes, what we're seeing here. Changing. So they lost $7 million. Is that million? Yeah, $7 million last year, and the year before they increased. They had and change in cash. I should say they're down $7 million, and this doesn't draw me that big a deal. Dividends paid. There's their increasing dividends, $570 million in dividends. Total cash flow from investing activities. Ooh, they got hammered on investments there. Why did they lose $2 million on investments? I don't know the answer to that. Total cash flow from operating activities. So that was a bad year in 2017. $900,000, or was that $900 million and less of cash flow from operating activities? I mean, it says in thousands. Yeah, $900 million. I just want to know how they're going to pay the debt. Let me just go back to the income statement. I mean, because they got the debt and they got the dividends. How are they going to pay that? I'll tell you what. Let's go here. Yeah, so let's take a look here. Operating. So they made money before interest expense and whatnot. So that's good. Net income compliance. So they're making net income. Yeah, so why is this thing getting killed so much? They only got $295 million in cash. That's all they got though, and see that's my concern. They got all that in cash, and their dividends are. I mean, what did they pay last year in dividends? They got $295 million in cash. They took on debt. No, they didn't take on. They took on debt here, but they haven't taken on any long-term debt since then. I mean, they took on some. Don't get me wrong, but not short-term current liability. So they took on debt here from 2014 to 15. Where are they going to get the cash to pay the dividends? Because, I mean, if you got dividends right here, their dividends $517 million last year, right? Wasn't it that dividend, right? $570 million. Net borrowings. That's the thing, right? That's what I was looking for. Net borrowings right there. So total cash flow investing activities, negative $1.7 billion. The net borrowing was $2.55 billion. That would be my concern because they don't have enough cash on the side. They're not making enough, it doesn't look to me at least, to be able to have cash flow to pay the dividends. So are they borrowing to pay the dividends? That's the only thing I could see is that they're borrowing to pay the dividends because they did net borrowing right there, $2.55 billion. And they had to pay $570 million in dividends paid. And net income, $950. Oh, maybe they do. Yes, I don't know, man. That's just adjustments to net income. I don't know what to make of that. That's an interesting stock to watch, though, for sure. I just, man, the thing when they're paying those big fat dividends, and I haven't read any of the research reports or anything. I really don't care that much. But the interesting thing is they got 12.71% forward projection. That's the yield right now. 12.71% with a low PE ratio. Why is that? I don't know what's going on with that. It's just odd to me. So that's interesting to me. That might be something you put in your ticker to watch. But where are they getting the cash in order to pay? Here, let's look at the statistics. That's the financials. Let's look at here. This is what I actually want to look at too. Where are they getting the cash to pay for those dividends? What time is it? 3:50. Yeah, that's what I want to look. All right, so price to book is low, 0.95. That's what you want to see. You want to see low price to book for sure. Profit margin, they're making profits, operating return on assets, return on equity. Return on equity can be driven misleadingly by debt. Return on assets is positive. Income statement, they got 1.85 in revenue. Gross profit, 1.39 billion. They had year-over-year earnings decline. That doesn't mean it's gone south in terms of it's still making money, but they had their earnings went down the last year over year. Okay, but that still is in the positive. That's good. Total cash $467 million. Total debt. See, that's my only concern. Total debt right there, $21 billion. But that could be those buildings right there. Yeah, there's our current ratio less than 1. I don't like that, but man, if I get a current ratio less than 1 instead of a price to book of less than 1, that might be a trade-off. Operating cash flow. See, that's a concern right there. Trailing 12 months. So something happened last year that put them back operating cash flow pretty big. I don't know what it is. Average 5-year average dividend yield 11.56. Payout ratio is pretty low. So I mean that just means that they have if they make $1 in profit, they're paying out 52.63 cents of that dollar to dividends. So that's good. I mean, you like a lower payout ratio for sure than a high. You don't want a payout rate. Well, I don't say that, but you don't want a payout ratio of over 100. That means they're literally borrowing to make the dividend payout, and they're not doing that here. At least I could see. And they got a number 3 there. That's an interesting stock to me, guys. I'm not going to lie to you. I'm not buying it. I just, well, they got the They got the asterisk here, but I can't go down to see what they're saying. Well, anyway, so I don't like debt to equity at 372. I don't like that. That means they got a lot more debt than equity. That's concerning to me. Cash per share is $1.38, which doesn't even cover the amount of the dividend. I mean, the dividend per share is $2 per year. So that's most recent quarter. So $1.38 cash per share, and the dividend per share is $2 for the most recent year. $467 million of cash, and their dividends alone are $570 million. So where's the rest? And then their operating cash flow is negative last year. Where's the rest of their dividend going to come from? I don't know. I mean, they're going to issue more debt. Well, they're already pretty heavy in debt. So I don't know. That's an interesting thing. They gross profit, their net income added to comp $1.25 billion. So theoretically, they could take it from their net income to add to the dividend, but you still got to pay down some of this debt. Yeah, something to think about. So this is what I'm looking at when I look at these shares. I like the financials for sure. Current assets, price to book, current ratio, total cash, total debt to equity. Price to book is always a big one right there. Just how much cash they have, because how they can pay the dividend if they don't have any cash. So anyway, I'm not sure that's happening. I just don't know. So it's something to look at. Hope this was informative. We'll see you guys next time. Thanks now.